Joining us right now is Larry McDonald. He's the founder of the Bear Traps report. And Larry, I think the biggest question out there that so many people are debating right now is, have we made it through the worst of this contagion when it comes to the banking crisis? You're pretty firmly in the camp that we have not.
Well, it's so much fun, Becky, to focus on AI and the incredible innovations that are going on. But at the end of the day, sit back and think about common sense. In 2020 and 2021, trillions of dollars, more than a trillion, of mortgage-backed securities, of commercial real estate loans, of treasuries were sold, were basically placed on the balance sheets of insurance companies and banks, okay? And investors and people sitting at homes right now enjoyed that. But those loans are still on the bank's balance sheets. And they're, when you take interest rates from 0 to 5% in 13 months, those loans are now worth somewhere between 75 and 85, maybe 90 cents on the dollar. And those are massive losses under the surface. Our 21 Lehman systemic risk indicators are pointing at the highest probability of a crash or a sharp drawdown in the next 60 days. It's the highest probability since COVID.
A sharp drawdown in what? In equities markets?
Yeah, in equities. So in other words, the Nasdaq's really ignoring the credit risk. And whenever we've seen this over the years, we saw this before COVID, we saw this before Lehman. What happens is, as a shock comes in, credit markets start to price in the risk, but equities don't. They focus on things like AI or things like the dot-com revolution in the 90s.
So, Larry, just to put this in full context, you're someone who tends to be bearish in the short term, more bullish in the long term. Is that an accurate representation?
Yes, but let's just think about the short term. What's been happening? We had the LDI scandal, or I guess the stress in London in October. Then it's rolled over to regional banks. Then it's rolled into Credit Suisse. Deutsche Bank CDS is now elevated. You've got MetLife, Lincoln Financial CDS is now blowing out, and then you've got commercial real estate loans that are impaired, and then you're talking about Capital One CDS, which is the consumer, that's now at multi-month wide. So this is clearly a rolling credit crisis.
What's the solution? And do you think the federal authorities recognize this and have anything they can do?
Well, if you saw, Mr. Powell, Chair Powell, was very nervous at the end of the last presser. And Bill Leisman did a great job of pressing him on some of these things. I really respect Bill. And, he's clearly very nervous because he knows under the surface what's happening. But the Fed is stuck in a narrative of fighting inflation, which they have to stick to because it's a very public narrative. They've preached this to the White House, but under the surface, he knows what he's up against. It's very much like 2018, where the credit risk is rising under the surface, and he's about to get kind of vetoed. Credit risk is about to veto the Fed policy path.
You said that this is like 2018, that you did not say that this is like 2008, and maybe that's a pretty significant differentiation. How does this play out differently? Well,
let's look at breadth, for example. So just look at breadth. So in terms of the stocks, the New York Stock Exchange stocks that are above the 200-day moving average, in February, you're like 71%. That's a strong bull market. And now we're down to 38%, which is December levels. So it's not so much like it's not a Lehman event. It's just a rolling, slow-moving credit crisis because the Fed's fighting it with behind the scenes with lots of liquidity. And it's not a concentrated event like Lehman. It's really spread out because banks, insurance companies, and all kinds of people own these bonds that were priced at par with 1% coupons, right? 1% coupon. And now interest rates are 3, 4, well, 5, 10% across high yield. And so those bonds that were sold to investors at 1, 2% and that are now sitting on bank balance sheets are in the 80s. So it's really more of a rolling credit crisis than Lehman.